How is everybody doing? Welcome back to the Banker Next Door. I am your host, Dr. Joe Berquist. Today's episode, we're going to get into private credit, a topic I have been talking a lot about recently. But before we jump in, I just wanted to say once again, congratulations to all the graduates at the Stonier Graduate School of Banking. Stonier week is over. It has wrapped up. Sporting my little Stonier shirt here. But again, just congratulations to all the graduates. So happy for you. I wish you nothing but the best on your journey out there as you continue to make your way through this lovely banking industry that we all love and hold dear to our hearts. But yes, absolutely. Best of luck to you in the future. And for those year 1 and 2 students, just keep on rolling. Keep on rolling, baby. Keep going. Okay, so I wanted to share with you this. I've been talking a lot over the last few months about private credit and how I felt that if there was a spot in the lending or in the economy that had turned into a bubble and that could potentially blow up, I said, private credit, that's your horse. That's the spot right there. And lo and behold, what happens? We got some new reporting from the Federal Reserve, and they just came out and said, wait for it. Federal Reserve research warns bank private credit ties create systemic risk. Yes, I saw this one coming. So we're going to look at two things here today. We're going to look at this very short article that it is actually here from the ABF journal. And then we're actually going to look at a little bit of this research here from the Federal Reserve itself. And I think, wait a minute, I think I might have, okay, here we go. But I don't want to read through this. I just want to show you guys a bunch of the charts and graphs and stuff that are in here. So let's see here. So this article is basically titled Federal Reserve Research Warns Bank Private Credit Ties Create Systemic Risk. The Boston Fed study finds banks $1.2 trillion in funding to private credit funds could trigger liquidity crisis during an economic downturn. So research from the Federal Reserve warns that increasingly close ties between traditional banks and the private credit industry may pose systemic risks to the U.S. financial system during an economic downturn. The private credit market has expanded dramatically from the $46 billion in 2000 to approximately $1 trillion in 2023, with particularly rapid growth after 2019. Boston Fed economist Jose Falat, Mattia Landoni, John Levin, and Christina Wang noted that the extensive connections between banks and the private credit market may be concerning, as these connections indirectly expose banks to high risks associated with private credit loans. The phenomenon represents regulatory arbitrage following the 2008 financial crisis. After banks were restricted from directly providing high leverage loans, they began funding private credit funds engaged in such lending, effectively circumventing strict banking regulations. Rating agency Finch reported that bank loans to non-bank financial institutions, including private equity firms and private credit funds, surged to approximately $1.4 trillion as of March 2025, representing a 20% year-over-year increase. The primary risk stems from revolving credit lines banks provide to private credit investment funds, allowing funds to withdraw hundreds of millions or billions of dollars to underwrite private business loans. The Boston Fed warned that if enough private credit lenders withdraw bank credit lines, their reliance on bank liquidity may pose a systemic liquidity risk to the banking industry. While the Fed acknowledged that current bank financing to private credit funds remains safer than pre-2008 leveraged buyout loans supported by dozens or hundreds of smaller loans rather than single large exposures, the credit lines represent funds' most senior liabilities, meaning banks would only incur losses under severely adverse economic conditions, such as deep and prolonged recession. So a couple of things I want to say here, and I'm going to grab this for a second. So anybody who has listened in on my Lords of Easy Money series. So here's the book, The Lords of Easy Money from Christopher Leonard. Christopher Leonard talks at length about how this whole cottage industry was created and how it was started by basically banks having to, when quantitative easing came in, when the Fed basically went to zero ZIRP, zero interest rate policy, started quantitative easing, It forced a lot of these banks and a lot of alternative, private equity hedge funds. They had to reach for yield because they couldn't get any normal yield. There was no longer a risk-free rate in the economy. So they had to reach out for yield. So they started with this private credit stuff, which was fine. And it grew slightly, over time. But then in 2019, and again, and from the report here from the Fed, I want to show you this assets under management at private credit vehicles. So you have in the green, you have private debt funds. In the orange, you have private debt funds, and in the blue, you have BDCs. So you could see here that the private debt funds and the invested capital and the dry powder have just absolutely exploded here in the last, just in the last 5 years. I mean, this has absolutely exploded. And like I said, and that to me, what has become highly concerning. But so you have two things going on here. First of all, you have banks selling off a lot of their loans to these private credit, institutions, because now you've created this beast and the beast needs to be fed. So their appetite is they want to scoop anything and everything up. Give us everything you got. The banks see some questionable loans on their books, particularly commercial loans, office properties, anyone, and they offload those loans. So, and I sat there and basically said, okay, they could do that, but is that right? Because now they're offloading that elevated risk to these other guys. And if this blows up, they're undoubtedly going to come back to the Fed looking for a bailout because wait for it. What did they say? Oh, this is now has a giant systemic risk. And furthermore, you have these banks providing these very large lines of credits to these private funds and private equity companies to continue to invest in these type of loans and assets. It's a big problem. And look at this one, bank lending to private credit vehicles. You could see here from these charts, utilization amounts. I mean, you just see after, it really ramps up to about, 2019. And then after that, it just explodes to the upside. And there's a lot of good information in this report. I just didn't want to try to read through the whole thing. But again, here, utilization rate of credit lines. 60, right now we're hovering at about, 60%, but, a little over 40%, between basically 40 and 60% utilization on the credit lines right now. Borrower leverage, BDCs, look at that leverage. Well over 50%. Other NBFIs are over, approaching 45%. So leverage is getting high. Banks' direct credit exposure to private credit implications. So average concentration, is kind of interesting here. Is average high is going down. Average similarity has gone down, which is kind of interesting. Let's see what else we got here. Anything else? Nope. That's all we got as far as charts and graphs. But other interactions of banks with private credit. Besides providing direct loans to private credit vehicles, banks have also engaged in other activities in the evolving corporate credit landscape, increasing the interconnections with private credit and other NBFIs. Banks are increasingly originating their own private credit deals by using minority stakes in PD funds and BDCs. Banks continue to expand their partnerships with private credit providers. In addition, to avoid the regulatory burden brought by the rise in leverage, banks are increasingly provided first lien financing for private transactions and sourcing the second lien or riskier and wider spread yielding part of the debt to a private credit manager. This type of financing can be structured as a synthetic risk transfer. Oh, remember those CDOs, collateralized debt obligation? Remember those lovely gems? Which enables a bank to compete in the direct lending space while unloading the riskier part of the notes, transferring the risk to private credit funds and other investors. What was I just talking about? One caveat in these arrangements is that banks are lending to the same NBFIs, including private credit vehicles, that are providing the credit insurance, meaning that in aggregate, some of the risk is actually not leaving the banking system as it appears, exposing banks to new vulnerabilities. So in conclusion, In this note, we document the size and characteristics of bank loans to private credit vehicles. Based on the data available, banks' credit provision to private credit vehicles is growing fast, but still small relative to other NBFIs. And the financial stability implications seem limited. Bank loans to private credit vehicles have higher utilization rates, higher interest rates, lower probability of default, and lower delinquency rates compared with those extended to other NBFIs. Sorry if I laugh at that one a little bit. Famous last words. We also find that U.S. banks remain well capitalized and highly liquid, allowing them to absorb a significant drawdown risk from private credit vehicles. Yeah, okay. However, we also see public BDCs increasing use of leverage compared with other NBFIs. Further, banks are also increasingly expanding their strategic partnerships with private credit vehicles. These developments and the increasing interconnectedness warrant close monitoring. We also recognize the limitations of current regulatory data and the difficulties associated with identifying banks' exposures to private credit in these data. Exactly. Ongoing efforts by the banking agencies implementing changes to reporting requirements should shed more light on the interconnections among banks, private credit, and other NBFIs going forward. So, yes, so private credit is a huge deal. It's growing very quickly. Obviously, banks love the growth. They love the money that they're making from this. Okay, understandable. But I think that the risk there in private credit is enormous. I think it is immense. And like I said, if I was a bet man and I was putting my money on it, if something was going to blow up, private credit to me would be the first thing, first thing to go. So anyway, with that being said, I hope people found this episode particularly interesting today. So with that, I will wrap up by saying, if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. I would be very interested to hear your comments and take on private credit and the private credit market. And as always, make sure to check out some of the other content on the channel. Once again, congrats to all the Stonier graduates as we wrap up yet another year at the Stonier Graduate School of Banking. I wish everyone nothing but the best. Make sure to check out BND's Strategy Room live stream coming to you Saturday night at 8 o'clock. And I hope everyone has a great day out there. I will see everyone again real soon. Thank you so much for listening.